Kenyan banks obviously had a year to forget in 2016 between non-performing loans rising by over $500 million, price controls being imposed on them by legislators, and private sector credit growth falling to levels not seen in nearly a decade. With pressure to cut costs as fast as they can, banks are now finally moving forward with the launch of a payment gateway that should allow ordinary Kenyans and businesses in this country to finally move cash around in real time from the bank accounts to their mobile phones and back. Earlier on, when I spoke to the CEO of the Kenya Bankers Association, I asked him if, given the collapse in private sector lending in Kenya, the association feels vindicated.
Not vindicated per se, but I think they had highlighted some of the possible consequences of passing the law in the format in which it was. And given that it was passed exactly in the same format, some of the dangers that the banks had been warning the public about the consequences may come to pass. However, what banks are now trying to do is try to minimize that impact by trying to recalibrate their models, trying to readjust so that you can be able to operate still within the confines of the law without having to shut down.
So what should we expect to see in the course of the year? More agency banking, more a reduction, as we've seen, for example, this week with Bank of Africa shutting down its branches and saying, look, we're going to focus essentially on digital service delivery platforms. Is that what we're going to see more in the course of the year?
I think you're going to see more of that. Banks are looking at their overall, operation model and trying to identify areas where they can be able to save costs, and that means rationalizing the branch network, where there are two branches within close proximity or serving the same customers. You may make a decision to merge the two into one, which means you close one, transfer the business to the other one. You might find some branches that are located in areas where it was more of experimental and it hasn't picked up. You make up a decision that you now no longer can justify having it, you close. You now leverage more on the agency banking, where you do not need to have physical infrastructure out there, but you rely on the existing infrastructure to be able to still deliver the service.
Inevitably, that does mean quite a few job losses, though, doesn't it? So how many jobs are we looking at that might be cut?
Inevitably, there might be some job losses, but I don't think that will be the area of focus. I think what is going to happen is we won't see much employment-driven growth. The growth that banks will experience most probably will be based on leveraging on the existing infrastructure, mobile banking, agency banking, the other existing fintech options, in which case they'll be trying to grow their balance sheet without growing the number of employees.
But you do know that's going to grab the headlines. The job losses will definitely grab the headlines. So as KBA, you have to be prepared to deal with the blowback from that.
Absolutely, but I think what might not be coming out clearly is the fact that there is a natural attrition within the sector. Now, if you're not replacing those that are leaving by natural attrition, your numbers will go down. And not because you are deliberately trying to reduce the numbers, but it's because as they leave, you are not replacing them. You are finding more efficient ways